Well guys, earnings season is in full swing, and despite some incredible earnings, there are some stocks trading at some historical discounts that might very well be some easy money. So let's talk about those stocks today, exactly what Wall Street's saying about them, and let's get down. Let's get the truth without the hype. So make sure you like this video if you like getting the truth without the hype, because that's exactly what you're going to get today, guys. All right, so as you guys know, earnings and really valuations are kind of all over the place. We got stocks running like crazy after terrible earnings. We have stocks that have incredible, great earnings that just really aren't really going anywhere, and all kinds of stuff in between. So let's try to make sense of it all. Let's get through all the noise and everything else. Let's see exactly what Wall Street's saying. Again, get you guys that truth without the hype. But always keep in mind, if you're wanting to learn about valuations and you're serious about learning how to invest and you want to work directly with me, make sure you take advantage of the earnings flash sale. It's getting ready to end. It's the pinned comment down there. We'll talk more about it at the end. But let's get into Wall Street and see exactly what they're saying.
Welcome back to Market on Close. I'm Tom White. It's time to discuss Alphabet earnings, a beat, and then we'll look ahead to some tech results for next week. And for that, we welcome in Robert Shine, Chief Investment Officer at Blanky Shine Wealth Management. Welcome to the show.
Great to be with you.
All right. So give me your takeaway here. I think it was almost a sigh of relief for investors as far as Google Alphabet's earnings, just due to the fact that the expectations were so low.
Expectations were low. Google's, did report their operating net income more than doubled. That was a positive. They beat both in the top and the bottom line. Again, another positive. And this should serve as a guide for what we're going to see next week with the remainder of the Mag 7. But, they beat on the top line. They announced share buybacks.
Yeah, so obviously right there off the bat, expectations are what they are. I don't know if I would necessarily call them low, but given the fact everybody said that they were dead or dying or ChatGPT's killing them and all these other narratives that are out there, none of that showed up in the earnings at all. Obviously, we'll see what else he says about it, but I mean, I don't know. I put out a video in my group. We broke down point by point by point with the actual data points from the earnings, and it was anybody. I don't care about low expectations. You could have had a high expectations, and they still exceeded those as well, in my opinion, of course.
And at the end of the day, they increased their dividends, which always is welcome. One of the key components was the cloud computing. That was a highlight. That grew by 28% this year, but they didn't provide too much guidance as it relates to the advertising spend. And that's the unknown of unknowns because of the current backdrop that we're in the macro backdrop.
Yeah, when you take a look at that, Robert, I think that was the sigh of relief that digital ad spend actually came in just a little bit above expectations. Internet search advertising came in at $50.7 billion. That was up 10%, just above estimates here. So does that give?
Think through that. Search, ad revenue, up double digits in a business and in a spot as mature as Google. Just think about that for a little bit and tell me what's killing what here.
Maybe a reprieve to maybe some of these other companies that are going to report next week that rely, Meta Platforms gets 96% of their revenue from digital ad spend. Amazon, they continue to grow their advertising arm. So these are, almost, setting the tone maybe for some of these tech names that have been beaten up.
That's so true. And we can't ignore, obviously, we are all subjected to, especially these companies, the sensitivity to the macro backdrop, as we've talked about. But what we're looking for, a consistent theme from basically all of that's going to be reporting next week, is the guidance. We know that's going to be negative and uncertain, but really is the capital expenditure component to each one of these companies. By that, I mean, let's take AI as an example. Are Microsoft and Amazon going to still commit their $170 billion combined to AI, or are they going to pull back? That's a question that we all, as investors, want to know on the earnings, as well as cloud.
So when I think about that, to just kind of help answer his question there, every one of these businesses could easily spend on all that, on all the AI spend, actually increase your AI spend, which some have actually done, and still be just fine, because these businesses, especially the Magnificent Seven, they spit off massive cash flow, massive cash piles. They don't have to slow down anything, regardless of what, the tariff does and doesn't slow down and all that sort of stuff. It's all still to be sorted out over the next few months. So I'm not going to try to guess here. But no matter how it works out, they have no reason to pull that back, given the amount of money that they print. Now, obviously, will that hurt earnings in the short term? Yeah, obviously so. If you got less revenue, less profits coming in, of course, then that, and you're still spending, up here on the other side, of course that hurts. But if you understand the long game there, you understand that's temporary, that's short term. That's not a long term fundamental problem with the business. Now, I'm sure these guys will all go on there and say, oh, I don't know, they may be dying, and all their other stupid narratives that they pull up. But the reality is, if you're paying attention to the earnings and you understand these businesses on a high level, it's just simply another opportunity if that happens. But I see no reason for any of them to pull back their AI spend. Obviously, Google didn't. So I don't know why any of the rest of them would too. And I think it would be a mistake for that management team, given how much profits they make, given how much cash flow they have coming in, to actually do that at this stage.
Performance, does that continue to grow? AWS could be a huge continuing driver for, let's say, Amazon. And so all of these little factors are going to tell us sort of the health of the existing tech market. But let's not kid ourselves. Regardless of the macro backdrop, there's still a war within mega tech and these hyperscalers to win the race respectively. So I don't see them, even if they wanted to pull back based upon economic uncertainty, your competitor can take 5 or 6 leaps ahead of you. So I don't think there's going to be too much pullback on the spend investments.
Okay, you came around with the same answer there. And again, there's going to be more than one winner in this whole AI race. I can't stand it when these guys come on here continually trying to act like it's a zero-sum game. It's not. There's going to be multiple winners. There's going to be multiple ways to monetize it, not just one. And there's going to be multiple ways to win at this game, maybe hundreds of different ways to win at this game, not just big tech, small tech, up and coming companies, a lot of different ways to win with AI. So all this sort of talk like that, that's just for media narratives and clicks and stuff like that. The reality is they all want to win big for their shareholders, and there's room for everybody to win in the AI race, more importantly.
Yeah, I think Microsoft already came out and clarified, $80 billion they're expected to spend this year on the AI infrastructure build out here. But when you look at the Fortress balance sheet and the valuations from some of these big tech names that, they're in bear market territory off their highs from just a month or two ago, they got Fortress balance sheet. They've got a lot of cash in their balance sheet. Their free cash flow is pretty rock solid at this point. Does this lowered valuation provide some opportunities here for investors?
Without a doubt. I mean, I don't think we're out of the woods as it relates to, markets made some constructive movement to the upside this week. It's refreshing after the 6, 7, 8 weeks of negative to maybe potentially close on an upside. But let's not forget, we did gap up on the S&P a couple of times this week. And historically speaking, we always have to retrace and close that gap. Whether it happens sooner than later, no one really knows. But the earnings could provide that backstop, if you will, as we continue into next week. And then from a valuation standpoint, we have seen the PE come down, even on the S&P 500 to 19, and we were at 23 just 8 weeks ago. So there's been a lot of sort of opportunity given to all of us in this market. And then specifically, if you look at the Mag 7, one of those areas that we like is Amazon. Amazon's valuation relative to where it is historically, the valuation's cheaper where it is today than it was all the way back in 2009. And oh, by the way, this last quarter, Amazon's contribution to the S&P 500 year-over-year earnings growth was in the top 5. So they're still growing. They're still, relative to, from a valuation standpoint, looking very attractive.
Yeah, getting a little bit cheaper. Still.
Yep, can't argue there at all. And think about the time frame. Think about the actual recession and actual situation back in 2009. Versus anything that the tariffs could happen today. I understand there's doom and gloomers out there, but you got to ignore that sort of stuff, just like you got to ignore the hyper bulls as well, that everything's going to the moon. Way worse situation, and yet here we are sitting at a cheaper valuation than it was back then in regards to valuation. I've been gobbling up shares of Amazon now for a while. Same with Google, same with everybody else that's been on a cheap valuation lately. You go where the deals is. That's part of investing. That's part of what we teach here on the channel is I can't predict the future. I don't know where stocks are going in the short term. I also, don't get a choice. I want to add more to this stock. Hey, great. I would love to add more to Palantir. Sure. But the time to do that was last year. Unfortunately, it's not this year. How it works, but last year it wasn't really as prudent to add to maybe some of the other stocks that we're getting a chance to add to right now. I don't remember Amazon being cheap on a valuation standpoint last year as compared to what it is this year. So you just got to kind of take what the market gives you at the time and just be happy and move forward and keep that long term in mind.
Down 21.75% from those all-time highs that we saw at the beginning of February. So, and that maybe that's the key, Robert. When you look at a name like Amazon, maybe one of their segments or silos of revenue generation might not be growing that well. Maybe they're in line, but then you've got the Slack pickup in advertising, right? That's become a huge major driver. 18% growth last quarter from the advertising side of it. We don't seem to see any pullback in that spend. So is that one of the reasons that you like it? Or is it just the fact that, hey, cloud computing still growing? They've got the retail side of their business, which has been doing spectacular also. It's just a culmination of all of the parts.
It's a culmination of all the parts, but keep in mind, obviously there's the ad, there's the cloud, there's retail, and there's also cost cutting that Amazon's been doing for the last 3-4 years. So the turnaround story is real. And oh, by the way, there's the AI upside. The AI exposure of what Amazon is actually doing will provide the opportunity for the acceleration of the top line growth. We've seen them do this before. I believe the stock is positioned, the cash flow is impeccable. So we're going to see, Amazon could be relative to valuation or relative to Mag 7, one of the most attractive. But for all those reasons, it's one of the things where we like a market like this because it allows us to take advantage of a company like that when it's down.
Yeah, I think some people buying over the last week here.
Yep, we were buying. Hopefully you guys were out there buying. If you're interested in Amazon, over the past few weeks, we've gotten some great deals on that stock. Hey, like I said, take what the market gives you. Not going to try to make sense of it. Market does what it wants to do. Some stocks are to the moon right now. Other stocks are cheapest valuations in a decade or more. So hey, you got to take what they give you. All right, so we'll go ahead and stop the video right there. This is kind of the bigger point that I want you guys to take away from this video and to understand the time that we're in right now. You get these strange times where we just get valuations all over the map. You have a lot of chaos on the market. You have a lot of noise in the market. And it's your job as an investor to stop, look through the earnings, and then decide what is actually going on with your companies. And you have to ignore the noise. I put out a long video to my group this weekend. I know a lot of you guys aren't in the group. I understand that. But it was discussing all the noise around Google, all the noise around valuations, and everything else that's going on right now with actual facts, with actual data. That's what you have to do. You're listening to an earnings call. You're listening to any earnings call, Tesla, Apple, whatever your stock is that you're focused on at that particular point in time. You have to ignore all the noise, all the commenters, all the social media garbage that's out there, all the little pretty charts and graphs, and just simply get into the earnings, get into the execution, understand the valuation of that particular stock, and then make decision from there. If the business is performing and you like the valuation where it's at and you don't have a full position or you want bonus shares, you go ahead and you add shares at that stage. Or if you're doing a simple DCA, just continue your DCA if you like what you saw in the earnings and everything's coming along. The thesis is still intact, no fundamental changes, business is going good. Who cares? Wall Street beats it down. I don't understand why Tesla can have not really good earnings and it flies. And then obviously Google can have great earnings, everything rock solid, and it barely moves. Again, Wall Street. I'm not here to try to figure that out. I'm here to take advantage of it. And that is your alpha as an investor. If you want to work directly with me on getting those valuations, understanding the concepts that we talked about today, make sure you take advantage of the earnings flash sale that is live right now, where you get to do exactly that. We got 5 free courses. We got free coaching. You want to be a part of the best 6, 7, and 8-figure Discord out there helping you with all this. We got tons of exclusive videos we put out every week. Guys, there's so much content involved in our Discord. Check out the pinned comment, see if our membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.